Hi, guys, and welcome back to our ACCA SBL series. And in today's session, we'll be diving deeper into corporate strategy and portfolio management, which is a fascinating topic. We'll be looking at a lot of theoretical concepts and models and also understand how these are applicable in your professional life. So please pay attention. Now, if you ever wondered how large companies like Tata Group, Reliance Industries, or Unilever manage multiple businesses across industries, this is exactly where the portfolio strategy comes in. As ACCA SBL students, it's important to understand how corporate level strategy differs from business level strategy. So the focus isn't on how one unit competes, but how the corporate parent creates value across all the different business units. We'll also be looking at some real life examples, discuss models like the BCG matrix, and explore growth options from internal development to acquisitions and alliances. Okay, and let's dive deeper into understanding how the corporate parent role is and what exactly does that mean. At the corporate level, the management operates above individual business units. This layer, the corporate parent, doesn't deal directly with customers or competitors, but it plays a vital strategic role. Think of the Tata Group. It owns Tata Motors, Tata Steel, Tata Consultancy Services, and even more, many more of the units, all operating in completely different sectors. Tata Sons, which is the parent company, provides direction, allocates resources, and ensures synergy between its subsidiaries. The key question for any corporate parent is this: am I adding value to my subsidiaries or just adding another layer of cost and complexity? And a good corporate parent, by the way, should help the business units grow, innovate, and become more efficient. A bad one slows them through too much bureaucracy, misalignment, and steps and procedures, and making their life difficult by asking them to comply with certain processes, but not sure whether those processes are adding value through the to the entire setup. Okay. Now, having a corporate parent like Tata Sons, and within the Tata Sons umbrella, you have all of these different businesses: Tata Chemicals, Tata Steel, Tata Motors, Tata Power, so many of them, right? So, see, this corporate parent, Tata Sons, how can it help create value? It basically does that in three ways: envisioning corporate intent, setting out a clear mission and vision for the entire group. Now, mission is the very reason for your existence, and vision is ultimately where do you want to be. Now, for instance, Reliance's goal is to become a global leader in green energy. It provides direction across all its business divisions. Then, performance intervention, monitoring, mentoring, and supporting subsidiaries. For example, Tata Sons ensures each Tata company upholds the group's reputation and ethical and financial standards. And then, resource provision, providing services individual strategic business units cannot easily develop, such as legal expertise, financing, branding, or R&D. I mean, a great example could be Alphabet Group, Google's, parent company, which gives strategic resources and autonomy to ventures like Waymo, self-driving cars, and the Google Cloud. But it's not the case that, having a corporate parent will always enhance value. Corporate parent can destroy value as well if the function is not performed in the correct manner. See, not all corporate parents succeed. Sometimes they end up destroying value through inefficiency or over control. And what are some of the common pitfalls? Political power games, internal politics where corporate ambition outweighs business logic. I mean, every organization that I have worked in, I have faced far too many, and not just me, everyone. We have all faced political games, and that in most cases is to the detriment of the company as a whole. Okay, then organizational complexity, too many layers slowing down business decisions, and decision making delays. When approvals take months, opportunities disappear. Like General Electric, for example, became overly diversified and bureaucratic in 2000s, leading to inefficiencies. Similarly, public sector companies in India often suffer from over centralization, slowing progress and innovation. You know what it does is it creates this atmosphere of red tape where you have to take approval for everything, and that ends up destroying any potential for value creation. Now, when it comes to the corporate parent, like the Tata Sons setup in this case, or Reliance as a whole, there are three strategic rationales for corporate parents. Johnson, Scholes, and Whittington developed three distinct rationales for adding value, each representing different approaches to corporate parent roles and responsibilities. Now, uh, one is that of being a portfolio manager. The corporate parent acts like an investor, buying and selling subsidiaries based purely on financial returns, and that means there is a slightly detached approach to managing that entire company. Then he could be a synergy manager, which seeks to create synergies between its subsidiaries, Tata Motors and Tata Chemicals. Is it possible for the two companies to share resources? Is it possible for the two company to have a common manager running the show, or can they make use of each other's unused capabilities to develop their individual businesses? Like Tata Motors has an unused warehouse. Can it be used by Tata Chemicals and thereby saving warehousing cost? So that kind of a synergy you can be on the lookout for. Or parental developer, the parent actively supports subsidiaries that aren't yet reaching their full potential. Basically, we are talking about companies and entities that are yet to reach a level of growth in their entire journey, and which is why the corporate parent is helping to nurture each one of them. Okay, so that way, what it is trying to achieve is it is like the parent who's feeding all the necessities to the child and making sure that the subsidiary entity starts developing in its own right. Now, what is this portfolio manager approach? See, in this approach, the corporate parent acts like a financial investor. The focus is on the returns, not on operational involvement, which is why I said it's a highly detached way of running the operations, right? The parent buys undervalued businesses, improves them, and sells underperforming businesses. Now, when you're talking about how you would look at a portfolio of shares, you would buy and sell shares depending on, you would buy and sell shares depending on which share is giving you a higher return, which is not performing. Similarly, here, a portfolio manager looks at entire businesses that way. I mean, think about Berkshire Hathaway, which is led by Warren Buffett. It owns companies in insurance, railways, energy, and manufacturing. But Buffett does not interfere in their daily operations. He simply manages the portfolio to deliver maximum shareholder returns. The challenge, the parent must have a strong investment discipline. Poor acquisitions or wrong timing can destroy wealth quickly. Okay. And it is necessary that, the person should have investment acumen. He should be able to visualize the market, the conditions in the market. Only then he'll be able to add any significant value or make a long lasting impact, so to say. Then you have the synergy manager creating shared value. What is synergy? Synergy is basically two organizations coming together and delivering 2 plus 2, not 4, but delivering 2 plus 2 equal to 5. In your AFM syllabus, if you have done AFM, we have discussed, so many, we have had so many conversations where we tried to quantify this synergy for the users for decision making purposes. Now, what exactly is synergy? It is an approach which focuses on creating values by sharing capabilities between businesses. And the idea is that the whole is greater than the sum of the parts. So 2 plus 2 is not 4, 2 plus 2 gives you 5. For example, sharing R&D between or technology platforms or common procurement systems to reduce costs, cross-selling and shared branding. What is cross-selling? One company, Reliance, say for example, Geo, selling goods or services to another client which is already onboarded by another Reliance company. Reliance India, it really exemplifies this. They are into refining, retail, and telecom. All units leverage shared infrastructure and financing capabilities. They operate out of the same head office. Maybe, they are sharing a printer, they are sharing human resources, they are sharing so many different resources, thereby trying to optimize the cost. I mean, globally, Procter and Gamble (P&G) it uses centralized R&D to develop new products like Olay, Gillette, Pampers. But see, achieving synergies is not easy. Management or managers will often act in self-interest, and cultural clashes can block collaboration. So synergy only works when corporate culture encourages trust and shared goals. When we talk about shared goals, what we are trying to say is, see, the two organizations, although they might have a different of they might have a different place or a different position they want to reach, yet there has to be a common, see, they have to work on similar principles. Their approach to work should be similar, which is why, if there are cultural clashes, the synergies might not be achieved. Like, Satyamed as a faculty partnering with another faculty to come together and deliver a bouquet of courses. Now, that will be possible only when both of them work with the same thought process, same set of objectives, and have similar philosophies when it comes to dealing with students, right? Then we have the parental developer or capability transfer role. What exactly happens here? In this model, the corporate parent actively develops its subsidiaries by transferring skills and resources. Like, there could be a company that has a global marketing expertise. So it is helping other strategic business units enter new markets. Like how Unilever trains local managers globally. Like Unilever on a global level has, of course, Hindustan Unilever, which is an Indian company. So they are transferring that marketing expertise here. Or brand recognition, leveraging a strong brand name to boost smaller subsidiaries, like Tata lending its brand credibility to new ventures. And with the Tata name behind these new ventures, they also have a better chance of growing and developing. Negotiation skills, supporting subsidiaries in large contracts, government projects, or international partnerships. And then, of course, R&D innovation, transferring core technologies to units that cannot develop them alone. Maybe the Indian arm doesn't really have the scientists or the research and development facility to develop it in-house. So Unilever will transfer a technology that it has developed. So the parent is a coach. He's not just a shareholder, but he is a coach. And it guides them in so many different areas. With that in mind, I now want to shift our focus to a critical model which is called as the BCG matrix. Now, as ACCA students, I am sure you have heard of BCG, Boston Consulting Group, which is one of the big three companies when it comes to consulting. And this model was developed by BCG. It provides a strategic framework for assessing product portfolio strengths and determining optimal resource allocation strategies. The matrix uses two critical measures to evaluate product attractiveness: market growth rate and relative market share. Now, what we are going to do is, when I say market growth rate, how attractive the industry is, and relative market share, how strong your position is as compared to competitors. What part of the matrix, what part of the overall market can you attract and, sell goods to? So there's a simple grid which helps you to visualize how business units are growing, how they are functioning, and you make four classifications, okay, depending on how much is the market share and what is the growth rate. So let's break down the BCG matrix into, there are four quadrants or four categories. BCG matrix is an inward looking analysis. A company will look at its own portfolio of products to be able to identify which unit or which SBU needs more of its attention, which unit or which SBU is generating more value. That is basically the idea behind BCG matrix. Now, there are four categories, okay? Stars, cash cows, question marks, and dogs. When I find this such a silly way to, describe a portfolio, like why dogs? See, cash cow is still okay. It's a fairly regularly used term. So, what are these four categories? If I were to think about it in terms of how much market share they have and what is the growth potential, then stars are those SBUs within the company which have a high growth rate and which have a high market share. So these are basically future leaders like Tesla, within the whole umbrella in electric vehicles. That would have been the star category portfolio for the company. Or for Reliance Geo, the brand is a star because that, of course, telecom sector, high growth rate, and of course potential for a very high market share. Cash cows are those which are, entities with a low growth rate but a high market share, and they generate steady cash flows. From the Tata Group perspective, if they were to analyze things internally, a company like TCS would emerge as a cash cow, steady growth, steady cash flow, low growth maybe, but the market share is pretty high. Then you have question marks or problem childs, high growth but low share. They need investments to become stars, or otherwise, they risk becoming dogs. Like Tata's e-commerce venture, Tata New, is still finding its footing. and again not really able to crack the market like that, which means it needs more investment, it needs more innovation. And dogs, unfortunately, as cute an animal as the dog is, those those verticals which have low growth or low share are basically classified under this category. They drain the resources and you might have to sell them or shut them down. And when you are analyzing portfolios, by the way, in the pre-seen material, this is one model that very commonly is, applied, the BCG matrix, to recommend resource allocation and justify investment priorities. Now we'll understand how do you strategically apply the BCG model. Now, with the BCG matrix, it provides four main strategic directions. Okay, the first one is hold, where it says maintain your position. You have a stable cash cow, hold on to it. For a company, ACCA business right now, if it has been doing it for a while, could be a stable cash cow. Don't divest, maybe don't invest further because the growth rate is slow, but hold on to it. Then, if there is a possibility that a particular business or a particular vertical has potential to, become a star, then you should invest more so as to help it grow. Uh, the third policy is harvest. Maximize short-term profits before decline. A particular vertical or an SBU is very, very close to, its maturity stage. So till the time you can milk it for what it's worth, take all the possible advantage before, the market goes into decline mode. And unprofitable segments, divest, exit. Hindustan Unilever consistently divests underperforming brands while investing in high potential categories like personal care and nutrition. The goal is balance. Balance your portfolio in such a way that you have cash cows funding the stars while problem children and dogs are continuously evaluated. If the performance is declining further, you should make an effort to divest from, that particular segment and move on to something, which will lead to a better growth potential. But this BCG matrix classification, in my opinion, it's way too simplified. That high growth and high market share. How do you know, or how do you treat a category which has a high growth rate, but the market share is not yet large? The market share is somewhere, it's neither too small nor too large. How do you treat such a vertical? Okay, then. It oversimplifies complex businesses. Okay, not every small player is a failure, not every large player is a confirmed success. It ignores synergies. Many products share R&D, branding, and distribution, and closing down, one of these products might have an impact on the capability of the other division. For example, you have, say, three divisions. Like, think for a fact that I'm running three different courses: ACCA, CFA, and CMA. Now I decide to shut down the CMA course, but there were faculties in CMA whose expertise I could use for, teaching management accounting and PM and all of that. After shutting down that vertical, I don't have the resource to teach management accounting, and that means I have to hire the resource from outside. And it assumes that the markets will be stable, but in dynamic economies like India, growth rates can shift very, very rapidly. So while the BCG is a great starting point, it should always be combined with deeper strategic analysis, like Porter's five forces or, Pestel. So it has to work together, because BCG matrix is an inward-looking analysis. You look at your own portfolio. Pestel is based on the external factors. So the correct combination of two will help you analyze businesses better. Now, this when it comes to the public sector also faces portfolio challenges, because their issues are how to allocate limited funds amongst competing priorities. So what the matrix in case of a public sector does is it basically evaluates two dimensions: ability to serve the public, the value for money parameter, and political attractiveness. Will it get public support? Will it get support from the governing bodies at the moment right now? And can you do something so that you can use that patronage, that leverage, and grow your organization further? For example, there are public sector stars, education and healthcare programs. For example, they are very well funded, effective, popular, and people would want to associate with these causes. So education is something, which will always receive public support. Healthcare is something which will always receive public support. Then political hot boxes, popular but inefficient, like state railways. Look at Indian Railways for that matter. Popular, such a big chunk of our population relies on it, but at the same time, very, very inefficient. Then golden fleece, overfunded, low need projects like EV charging stations in rural areas. Now you have the funding because you are like one of those funded startups with private equity funds backing you. Now what do you do with that money? You either use it wisely or you set up charging stations in villages. But nobody knows of electric vehicles in villages. So that entire idea is, just burning money, but not really making an impact. And then backdrawer issues, low priority, low effectiveness, like, redundant municipal facilities, nobody uses them anymore. And once you do this classification, it helps the policy makers to decide where to invest taxpayer money in the most effective manner. Okay, but once you have identified, using the BCG matrix, or, you have done an analysis for the public sector entity, then you will have to decide how to fuel economic growth. Okay, internal or economic growth means expanding using your own resources, not going for acquisitions. A lot of companies, their only expansion footprint is by acquiring other companies. So either you do that, you go out and acquire other companies, or you try to build it on your own. See, when you try to build it on your own, you have full control over how the operations are working. There is cultural consistency. And because you are growing at a gradual pace, you don't need a huge investment on day zero. But if you are acquiring another entity, then naturally the amount of investment required would be higher. And it will demonstrate. I mean, if you don't have the money, then expansion by way of acquisition is not going to work. In that case, going for organic growth is what you would prefer. But yes, one must be okay with the fact that the pace of growth will be slow and there will be challenges along the way, but at least the growth will be sustainable. I see so many startups today whose only way of growing is by acquiring other companies. So they don't know the DNA of the business they are acquiring. They don't know how the target business works, and yet they go out and acquire. It leads to cultural clashes. They don't understand the business, so they can't set the right growth parameters, and it never takes off. Imagine Infosys expanding into digital consulting organically, or Apple developing its own chips rather than acquiring a chip maker. Organic growth is often the most sustainable growth, but it requires patience and capability development, which not everyone will have. See, you have to understand you can't beat time. Okay. There are so many people I know, they're like, oh, we want to become the biggest ACCA provider in the country in 1 year. You can't beat time. You came 10 years later, so your growth is going to be that much slower. And in today's fast paced world, where the expectations have to be fulfilled on day -1, otherwise, your chances of success go lower. I think investors today, companies today don't have the time to let businesses grow through their word of mouth. You don't have the patience to let the businesses foster. You don't have the patience for that to happen, which is why it might in most cases be, a losing proposition. Another way of fueling growth would be by going for mergers and acquisition, in which case, see, if you have the right kind of funding, you acquire an entity that was already in existence. So you get instant entry into new markets, but you will have to pay a lump sum amount on day zero. You get access to established brands and expertise, and you can prevent competitors from acquiring the same target. And you can go very, very aggressive provided you have the right kind of funds to back you. But there are challenges along the way. There are integration issues, there are cultural clashes, and there is a possibility of overpayment in bidding wars. That could be, because two or more companies would be fighting to acquire the same entity. That would lead to a lot of things slowing down. I mean, think about Tata Motors acquiring Jaguar Land Rover, which was a major global success. But AOL Time Warner, one of the biggest M&A failures. It shows how mismatched cultures can destroy value. And when you are analyzing a merger, or when you are analyzing a potential acquisition, you have to understand that it's not just numbers, or it's not just looking at the appropriate exchange ratio, but looking at all of these aspects also. Because if you are hailing from different geographies, if you come from different parts of the world with a different approach, then it might become difficult to make the acquisition work. Which is where the whole idea of synergy comes into picture. What is synergy? Synergy means that when two entities come together, their combined value is greater than the sum of their individual values. So basically 2 plus 2 is not 4, 2 plus 2 is 5. You get synergies in the form of, sales level synergy where the two entities can access each other's customer lists and thereby grow far quicker as compared to had they been operating on their own. There could be cost related synergies where you save money by using some shared services or by using some shared facilities. You could also share critical resources, and the shared expertise could help benefit you. Or because of the larger size of the organization, now you have access to better capital and at a cheaper rate, which basically means the overall cost of capital will go down. So that is an investment level synergy. The Disney Pixar merger, it created massive creative and commercial synergy. I mean, think about it in terms of animation and how that could have led to enhancing the strength of both firms. Strategic alliances and partnership models are also gaining a lot of momentum. See, not every collaboration requires a full merger. Strategic alliances will also allow companies to share resources while they remain independent. So, thinking about, say, scale alliances, what is a scale alliance? Combining certain operations to achieve economies of scale, maybe better bargaining power with suppliers, or some sort of a complementary alliance where you are sharing strengths to cover weaknesses, like say Toyota and General Motors joint venture in the 1980s, or access alliances, partnering for market entry, like Starbucks. Starbucks entered India, it partnered with Tata. So that made it possible for them to access a lot of tier 1, tier 2 centers because they already had a global they already had a local player who knew how the market worked. So these kind of alliances, they will also foster a certain level of synergy, and it will help you to expand faster. You don't lose your say in the business. You still have skin in the game, but of course there has to be, that heavy. You need to trust the strategic alliance partner. When it comes to joint ventures, that's also another model you can look at. Two or more companies form a new entity for a specific purpose, like Maruti Suzuki. It's a long-standing Indo-Japanese JV that has combined Suzuki's technology and Maruti's India market access. A franchisee agreement, it runs local operations under a parent brand. If you know MACD in India is operated by Hardcastle restaurants in West and South. So that's an Indian company to which MACD has given its formula, its logo, its branding, and everything. And then it is operating stores through franchisee partners, thereby ensuring consistency and at the same time localizing the menus also to suit the palate of the individual customers of that region. And then licensing, where companies allow others to use their IP in exchange for royalties, like Heineken beer, brewed locally under license. That's not an Indian formula, but of course, you get the right to use that formula. So quicker growth and more speed along with local expertise. Now, to sum it up, see, corporate strategy is about how the parent company creates value across a portfolio of businesses. BCG matrix can help you to understand certain basic points. Okay. But after having understood that internal inward looking analysis, there's pretty little that you can do unless you have the right approach for the next step. That can come through organic development, acquisitions, partnerships, and the ultimate objective is to deliver value without, creating too much complexity. So be it Tata, be it Unilever or Reliance, principle is the same. Manage diversity strategically to achieve long-term value creation. Thank you.